Good morning, traders. On April the 5th, Tuesday, April the 5th, this is James stepping in for Steve Miley for our daily webinar recap and outlook meeting, Bull and Bear, or Bull versus Bear. And as Steve likes to say, welcome, welcome, welcome. And good morning if you are in the US time zone. Good afternoon if you're in the European time zone. And good evening to our Asian traders. It's quiet. It's pretty quiet. You know, I was going to start the meeting with a big yawn. Uh, global stock markets are largely unchanged. There's some like small firmness in some slight softness in others, but we'll get to that in a moment. The usual format today for those of you who are joining us for the first time, that's going to be we have a look at the data releases for the day. This is the fundamental analysis where we look at the data releases and the news stories, the things likely to be driving price for the day, and then a quick look at the charts that we call the technical analysis. And today I want to wrap up with a new segment. I'm going to call it James's Thought for the Day, where I'll just have a quick look or examine, maybe it's a piece of psychology, trading psychology, or something that I've noticed in the markets that I want to talk about, or I've noticed in traders' trading behavior. Today's thought for the day was inspired by an email I received yesterday from one of our funded traders. Shout out to Roger, who posed a question to me, and I answered on email, but I thought I might try and elaborate on today's meeting to give him a little bit more color and to really just to share that thought with you, the rest of our traders. But let's get on with it. Let's start with the daily data calendar, the economic daily release calendar. Today is PMI day. So what's PMI? Purchasing Manufacturers Index. Now, some of it's service sector, some of it's non-service sector, but essentially the Purchasing Managers Index, it's a composite survey. They take X number of companies, depending on where the PMI is calculated. I think in the US, it's like 150 companies that they ask, and in Europe, it's 300. But essentially what they do is they approach these companies, get them to fill in a survey about their what the purchasing managers, what their activity is. And if that number is above 50, it indicates an increase or an improvement in activity. Below 50 indicates a decrease or a contraction in activity. So above 50 is good for the economy. Below 50 is bad, but as always, there is a previous reading and a forecast that we look at, see what the market's expecting, see what the market's pricing in. That's what we want to look at, is when the data's released, it might be a positive number above 50, but if it's below the forecast, the market was expecting a better than released number, so it won't be bullish for stocks or products that indicate growth in the economy. Come on to that in a moment when we go through some of the data that's already been released and what's coming out. But yeah, essentially that's it. So if you've got a survey of 150 companies, what they do is the biggest company gets weighted more in that survey. Obviously, they have more significant impact on the economy. So what we call is a composite index that's weighted, and it's across a number of participants. Let's have a look here. We can see here we had European PMI this morning and moving into the UK PMI more recently. And we can see that the previous was in the 50s. The UK services PMI was 60. The forecast was for largely unchanged, maybe a slight improvement in the UK. And when you see numbers in green, it basically is an immediate indication that the number came out better than expected. So 56.1 in Germany, in Europe 55.6, in the UK, composite and services are slightly better, slightly improved. But you can also see here the importance that the number is given. So 3 bulls are the most important numbers on the day, 2 are not so important, or not necessarily important on the day, but sort of the weighting, the importance they give the people who develop this economic calendar, the weighting they give to that particular number in the broader scheme of things. And is it more likely or less likely to impact price? We can see mostly PMI is 2. We've got like 3 in the US and 3 in the UK being probably the most important of the 2 readings. But you know, we've been saying this for months now. Inflation's the most important thing driving price from a data perspective, and from a fundamental perspective. It's of course the geopolitical issue and tensions between Russia and the West after they invaded Ukraine, and and how that's being handled. We have some news on that coming up, but let's just finish it up on the daily economic release calendar. We can see going into the US, we have trade balance numbers out of US and Canada, but really it's not until 10 a.m. New York time, which is 3 p.m. UK time, do we hit ISM non-manufacturing PMI, or ISM as we used to call it when we sat on our trading desk. A couple of Fed members speaking later in the day. Watch for that. We're obviously watching when they speak what their view is on inflation. At the moment, it doesn't feel like there is much new news that we haven't already priced into the market. So worth having a listen, but don't expect a great deal to come out from that. So that's basically it. Like kind of a bit of a yawn fest today on the data front. Let's take a look at the news. So yesterday, Elon Musk took what I think it's about a 9% stake, was it, in Twitter, which was making him the single biggest shareholder of obviously one of the largest social media platforms. I can't remember the numbers, to be honest. I think it's like over $3 billion worth of investment for around a 9% stake. I know that it sent Twitter shares rallying 27%, which dragged up the broader market index, particularly like the Nasdaq. Be interested to see how that story develops. We're really more from an intellectual point of view than I think really there's nothing else to come out now and drive price from that. But I really interesting why he took such a large stake, and is there plans for a management change at Twitter, and maybe for even a slight format change. I know that Elon was talking about potentially starting his own social media platform, but probably figured, hey, quicker route to market and ultimately probably cheaper route would be to take a $3 billion investment in an existing platform. So that's what kind of drove the Nasdaq yesterday. As I said, we kind of got sort of a boring day on the data front. On the news front, what we're seeing is the US is ratcheting up sanction pressures on Putin, and it's announced that it's halting dollar debt payments from Russian government accounts at US banks. And this is going to sort of force Russia to do one of 3 things, which none of them are really appealing to Russia. That's either, if they want to continue to service their Russian government bond debt, they are either going to have to drain their dollar reserves or spend their new revenue that's coming in, if any, or just go into default. None of those are really appealing to them at the moment. But again, another step by the US to put pressure on Putin. Now, I want to just take a minute to look at this from a sort of a broader macro perspective. What's going on here? More importantly, what do we think the possible consequences are? So my feeling is this: Russia's on the back foot. Okay, it's already pulled out from certain areas in the Ukraine and pulled out from the surrounding areas of Kiev, and looking to focus their apparently looking to focus their their I guess attempted march forward or attempted takeover of Ukraine elsewhere, but things aren't actually going too well for them. Right? We know that that's been priced into the market in the last sort of 10, 15 days as we've had this pull off the lows and push higher. And so Russia's on the back foot, and okay, the war's dragging on, but Ukraine's putting up resistance. It's not going so well for Russia. It's going better for Ukraine than we expected. And rather than sit on the sidelines and see how things develop from here, we have um, the Biden administration in the US continuing to ratchet up the pressure. Now, that's probably strategically the right thing to do, right? We're winning. Let's push. He's feeling weak. Let's continue to put on the pressure. Let's continue. Let's now we've got the upper hand, potentially have the upper hand. Let's take advantage of that and continue to put on the pressure. They've also announced on Friday 300 million in lethal military assistance, and today plan on sending 10 of their newest Switchblade drones, which have the tank busting armory or missiles attached. So, they're really sort of kind of going for it and really pushing while they feel like they have the upper hand. And, I think like strategically, it's the right thing to do. But how's Putin going to react to this? Does he strike you as the type of person that's sort of willing to sort of eat humble pie, admit defeat, can't take the pressure, I'm going to back off? Well, for me, no. For me, he's the type of person that when boxed in a corner, when put under pressure, may feel the need to escalate. And that's what's worrying me. I'm worried, things are pretty quiet at the moment. We'll have a look at the charts in a moment. We've had this nice rally. I think we're falling into a consolidation period. I can't see us going much higher from here, and without sort of any real developments in Russia, I can't really see us going much lower. But I'm concerned that, while the world continues to put pressure on Putin, he's going to sort of lash out and maybe try and escalate or maybe have one final push somewhere. What does that mean? God forbid, weapons of mass destruction or chemical weapons, tactical nuclear strikes. God forbid. I mean, obviously, we all really hope that it doesn't go there, and our thoughts and prayers are with the Ukrainian people. But I'm concerned that Putin's going to feel backed into a corner and may escalate, and that's what's going to drive the price of our markets. If that happens, we can see, we'll obviously see things sell off, but that will be a fundamental shift on where we are now, and that will set tone and price for days and weeks ahead. So right now, I think we're kind of, from a markets perspective, playing a wait and see. The other thing of note is that investment professionals are becoming more bearish. So the CBOE, where the VIX is listed now, we plan on doing some lessons on the VIX, and Steve did a blog post a couple of weeks ago, on volatility. Incidentally, I'm about to follow up by the end of this week, hopefully, with another blog post taking a sort of deeper look on the psychological impacts of volatility on the trader. But we plan to do some more on the VIX, which is it's a contract that's traded on the Chicago Board of Options Exchange. Without going into it technically, what it is, I just want to sort of, if you're not familiar with it, it's known as the fear index. And the higher the VIX, the more it's a volatility index, but they call it the fear index. The higher the VIX price, the more volatility in the markets. And the lower the VIX price, the less volatility. So obviously we see, as a futures contract or as an options contract, we see, people placing positions in there when they are expecting a change. And right now what we see is the put-call ratio has pushed higher, and that's indicating institutional bets are betting that the recent rally is over and the market's looking to come off. So let's see. That's I mean, that just because the institutions, or some institutions are making bets that way doesn't mean the market's going that way. But just wanted to point that out, that some of the sort of bigger players in the market are looking at what's happened with the recent rally in stocks, and the sort of situation we're in Europe now, and also really sort of the outlook for the economy. So the latest Markets Live weekly survey has positioned for a recession as soon as next year. We've had this inversion in the yield curve, and so that's a good indicator that recession's coming. you know Stalemate in Europe at the moment. Perhaps we're ratcheting it up. Is he going to lash out? Potential for bearishness. It looks like the stock market rally is over. It's kind of run out of steam. So we have a few institutional players thinking, maybe it's going to sell off from here. I'm going to take a bet, and we can see that expressed in the CBOE's put-call ratio. That's it, really. I'm looking at the news this morning. There's not really much else to tell you outside what I've said. Stocks, oil, bond yields edge ahead of expected new Russia sanctions. We'll have a look at the prices in a moment, but again, there isn't a lot in here. Oil extends rally on prospect of more sanctions. Oil's in a range at the moment. We'll take a look on the charts. People are looking for news to fit the price action, I feel. What else have we got? This is just a quick look of the stock markets overnight, so we can see the percentage change. Look at it. Very quiet, small softness here in Europe. Small firmness in Asia. Hang Seng's up 2%. But yeah, there's further lockdowns in Shanghai, by the way. Shout out to my friends and ex-colleagues in Shanghai. My thoughts are with you. For those of you who don't know, I spent 4 years living in Shanghai from 2010 to 2014, building trading groups for Mercury derivatives and futures first. When I got there, actually, we had a group in Shanghai and a small group in Beijing, and I built those two out and actually opened a third office in a city outside China no one had ever heard of. That was until 2019. Yes, I built an office in Wuhan in China. We opened it in 2013. And so I'm very familiar with the city, having traveled there maybe 20 times. And nobody had ever heard of Wuhan before the coronavirus outside of China. Huge city, lovely city, actually. Very, very large student population. So there's further lockdowns in Shanghai. That might underpin oil. They've now locked down the whole city, but it hasn't really impacted the index there. We can see it's just a very quiet morning across all the indexes. Yeah, not much to see on the headlines. Going now to have a quick look at the charts. We have here. Let's do this. This is the daily E-mini, the June contract. And we can see this was the low actually picked out by our very own Steve Miley when if we go back to his charting from these dates, he picked out this low here, and then 1 2 3 4 5 6 7 8 9 10 11-day rally, slight pullback, a little bit of a sort of firmness from Twitter. Purchase yesterday caused the Nasdaq to rally. We'll see the Nasdaq looks a little bit more bullish. But I think that news is out of the market now, and we kind of closed below the open on this bar. Well, that's where we're trading. Sorry, on this bar. What does it mean? I, without any sort of fresh news that, hey, you know what? Inflation's not a problem, or we're not going into recession, or Putin says, hey, I'm sorry, and pulls out of Ukraine. I really can't see us sort of breaking this high and testing this level of resistance. And likewise, without sort of any sort of further escalation, I can't really see us sort of breaking this low today. this would be a fairly significant move in stocks. So I think what we're looking at is sort of sitting on this level of resistance, sort of drifting maybe sort of between this, if we do get a bullish a rally from here, towards this high here and these highs here and sort of this low. I think this is where we're going to be. Let's have a look at the hourly, see if we can get a better picture here. Zoom in. So this is the hourly. Actually a little bit of an uptrend here, an hourly uptrend. Interesting to see how this market behaves. Personally, I wouldn't be trading it while it sits between this high here and on this level. But you can see we've got a lot of green bar here. I think if over the next hour or so, if we start to soften and break this low here, we'll head down towards these levels here on the day. As I said, without sort of any sort of lack of any sort of fundamental news to drive price, hard to see it breaking below these lows, hard to see it breaking above these highs. I think we're in for a consolidation day today in stocks. Let's have a look at the Nasdaq. Now, the Nasdaq might appear a little bit firmer. That index was driven by the Twitter purchase yesterday. And we can see here, we've got a level of fairly important level of resistance here. It's held 1, 2, 3 days, this level of resistance. So if we're going to get some firmness today, this is going to be key resistance in the Nasdaq. Small level of support, not that significant. I've really just taken it from sort of these two sort of highs here. Level of support often become levels of resistance when it's broken through and vice versa. This, I guess, is the significant level of support that will probably drift between today, lacking any news. And this is it on the hour. We can see we actually have a bit of an uptrend going on here from way back down here. See if I can widen this out a little bit so we can see it a bit better. There we go. Yeah, go and get that. So, again, it looks like a pretty quiet morning session, certainly ahead of ISM. I don't think ISM is going to have a massive impact. Again, we've got these levels of resistance, which we highlighted on the daily. Let's delete that. It goes right back to this high here. So let's see how it behaves around this level of support, this level of resistance, breaking this level of support and this trend. We could see it sort of drift lower down to here. So that's kind of it for stocks. When we look at treasuries, they look very weak, but I think maybe it's time for, this is a bit of a bottom maybe here at the moment. We can see on the hourly, this is the daily and the hourly. Has got a trend line, level of support down here. There's not really much to say about treasuries at the moment. And oil was interesting because I noticed that it held this level here beautifully, this uptrend in the last day or two. So you can see we're kind of in this consolidation area. This is up at 110. This is down at around sort of 99, maybe 98. I can't really see, again, without any sort of lack of any fundamental news, much happening to oil outside, outside of these sort of levels of support and resistance on this daily triangle. Let's have a look at the hourly, zoom in on the oil. There's the downtrend. You can see actually it's found resistance on this downtrend nicely, 1, 2, 3 hour bars, and that's forcing it a little bit lower now. Looks like the bears are in control in oil. We have this small level here. This old level of resistance is now a level of support, maybe not a significant level of support, more significant down here around 101. Looks like oil maybe is going to fall off down to around sort of 101 level, maybe even down to sort of 98.50. So it'll be these sort of levels around here. So that's it for the charts. As I said, I'm expecting a pretty quiet day today. I was going to start the meeting with a big yawn, and because I think the markets are going to be quiet, which means don't get chopped up, don't overtrade. Pick your moments, be patient. I don't think there's going to be a lot of opportunity today. Right, that's it for the morning meeting. I just want to wrap up with a thought for the day. I had an email from a trader, a funded trader yesterday, who and actually, I hope he doesn't mind me sharing this. But on Friday, made money and then gave it back in the afternoon, and ended up fairly significantly down. And then today, he sort of kind of yesterday made money. And his question really was, when do I stop trading on the day? When's a good time to stop trading? I'm finding it hard to stop trading. Now, we're all different, right? We know that as traders, we're all different. We all have different strategies. Some of us are purely technical, and if there is enough time before the close for a trade to play out, and your technical indicators are telling you to enter that trade, then you should enter that trade. But what I want to talk about, is not necessarily your trading strategy. It's more about your risk management strategy and your money management strategy. Now, one of the things that I was taught as a trader early on in my career, and I continue to teach, obviously obviously today to today, but we used to teach quite rigorously at our professional trading groups, is that you don't really want to let a winning day turn into a losing day. Now, what do I mean by that? Some days when we start trading, we lose money. No matter what we do, we can't seem to get anywhere. Sometimes we start off and we lose money in the mornings, but we're still within our sort of our psychological important daily stop, where we really don't want to be losing more than we're capable of making, right? So let's say that number's $500. So let's say we're $300 down, and we might turn our corner and we might start making money, or we might continue to lose money, and we get to that sort of 354, 450, and we think, oh, today's just not my day. I'm not in sync with the market. I'm not feeling it, or God, I'm distracted. I'm worried about, my mortgage or my rent, or I'm fighting with my partner, or your mind, your headspace is just not in it, right? Stop trading, right? We know that. We know that this is the right time to stop trading. Particularly from a risk management point of view, we don't want those losses to escalate beyond what we're sort of capable of making within a day. And then on the flip side, we have good days, right, where we start trading and we start making money, and by sort of mid morning or a few hours into our trading, we could be like $500, $600, $700 up. Let's say a good day for this individual, based on the size that they trade, is $1,000, right? And that's sort of $700, $800 up, and they're on target for a good day. And then they hit sort of two or three sort of losing trades, and what can typically happen with an inexperienced trader, even with experienced traders, but what we see in experienced traders is this type of thinking kicks in. Oh, shit. I was up 700. Now I'm only up 450. If I could just get it back to 700, I'll quit on the day. All right. I just want to get it back. And if I don't need that 1,000. I just want to get it back. I just want to get, like, I know I can do it. I just want to get back to 700. And then they start forcing themselves into opportunities that aren't there, or looking for opportunities that aren't there. What we say is forcing the market to trying to give them money. And this is a fool's errand. And the next thing you know, they've gone from 450 down to 250 or 200, and they're like really angry with themselves and like, oh, crying out loud. Well, if I just, all right, okay, I just want to get back to 450, and that's it. I'm done on the day. I'm stopping, no matter what. And then all of a sudden they're down to zero, and they're like, now they're really angry, and they start thinking, well, how bad can this get? And of course, with the next sort of 2 or 3 trades, they're losing money, right? It's a really bad place to be mentally. It's that little frustration kicking in, that anger, and then what we call revenge trading, trying to take revenge on the market for stealing your profits and your P&L. All pushes you into a bad place, right? Now, you know, how things can unravel very quickly as a trader. But that doesn't really address, you know, where we should stop trading. And you know, if we're having these good days and we feel like we want to continue to trade, what I typically do and what I recommend traders typically do is put in like a mental trailing drawdown, you know, on your trading. So let's say you're up $1,000 and I want to continue to trade. I might say to myself, right, my trading drawdown is going to be around 30%. If I lose $300 and my P&L goes from 1,000 up to 700 up, I'm quitting on the day. Period. Now I won't like losing that 300, but what I want to do is I want to do two things, two really important things, right? The first one is the least important of the two, and that's protect my capital. And you're like, oh, what? Protect my capital? That's the most important thing, surely, James. Well, the answer's no, actually. You know, if I'm on up 1,000 and I lose $300 and $300 trading and I'm now up $700, yeah, of course I've lost that $300. I'm gonna be like, oh fuck, you know, I lost that $300. But what I'm trying to do is protect my trading P&L, my trading confidence P&L. So we talk about this in some of our lessons. There are two types of P&Ls: your cash P&L, your trading confidence P&L. And the trading confidence is your confidence in your ability to trade, but it's also your mental state about how you approach the market. If I stop myself at 700 and walk away for the rest of the day, as the rest of the day unfolds, my mental state is positive because I'm like, okay, I didn't, you know, close out on my highs, but hey, I still made $700 today. And you know, hey, I had the discipline to quit when I should. And those two thoughts, the fact that you're up on the day and you had discipline in your trading, sit with you and manifest with you until the next trading day. And it's much, much, much better to have those two thoughts sitting with you and manifesting with you as you go into the next day than sitting there being 1,000 up, losing 300, getting to 700, trying to fight to get back to 1,000, losing another 500, getting mad, losing it, going down, losing 400 or 500, and then spending the rest of the day and the evening sitting there mad as hell at yourself because you lost money, you let a good day turn into a bad day, and you're mad about the money, and more importantly, you're doubting your ability to be a disciplined trader, and you sit there all night, you know, "Oh, why didn't I have the discipline? Why didn't I stop?" You know, and all this is a really bad mental place to be in, and it's bad for your long-term development. So the best thing to do when you're having a good day and you're making money and you want to continue to trade, and you should continue to trade, right? Because you're in sync with the markets, you're reading the markets well, you're trading well, but put a trailing drawdown in where you're willing to give X amount back and quit. Now, what that X amount is down to you. You know, for me, 50% seems a little bit too much. If I've made 1,000 on the day and I end up going home 500 up, you know, I'll be a bit like, wow, that, you know, I gave quite a bit back, you know, but hey, it's still a positive day. And, you know, hey, I was disciplined to walk away, but that just seems a little bit much. 20% seems a little too little, right? Because if you're going to put new trades on, you've got to give them room to breathe and room to go offside and things like that. 30% feels about right for me. It might be different for you, and you really sort of need to figure out what works for you and what fits within your risk tolerance and your trading strategy. But try not to let good days turn into bad days, right? Really, really, really important that you try and avoid pushing yourself into that psychological area where you're going to be mad as hell with yourself and doubt your ability to be disciplined. Don't want to sit with that all night. Don't want to sit on that. Don't want to sleep on that. And you don't want to be coming in the next day thinking, right, I just want to get my money back. Okay. So I just want to leave that with you. Very, very, very difficult to end a trading day on its high, on its P&L high, bit like it's very difficult to pick the high of a market or a low of a market. Expect that you're going to end your trading day off your high. That's absolutely fine. It's very, very, very difficult to walk away when you've hit a few losing trades and you're still on side and there's still money in your account and you think, well, I've got a cushion, I can try and get it back. But if you've hit that drawdown that you've put mentally in your mind, stop. And please try not to let winning days turn into losing days. Even if you've been 2,000 up and you lose complete control of yourself and complete control of your trading, or you get caught on some breaking news and you find yourself only $300 up, don't get mad at that point and try and get it back. Stop, walk away, sleep on it. Sleep on the fact that you still got cash in on the day. Sleep on the fact that you had the discipline to walk away. You'll be a much better trader the next day for it. Okay, on that note, I'll leave it with you. Good luck today. Have a great trading day, and we'll see you tomorrow morning.